The Jackson Hole meeting is done and the Federal Reserve has confirmed it. Powell will be cutting interest rates down. We are moving back to easy money even though inflation is still very high. Don't forget that CPI is near 3%. It has been around there for over 12 months. The inflation fight hasn't been won yet, but the Fed has determined it is time to act now. According to Jerome Powell, the time has come. He's more confident that inflation will drop down to 2%. However, here's the bigger reason why he has confirmed the rate cut. The labor market is cooling. We have triggered the sum rule of higher unemployment, and to save the US economy, the Fed has to cut. Powell has to bring back the punch bowl. The big question everyone has is whether the cut will trigger growth or confirm the collapse of the economy. Now, history tells us that rate cuts after a hiking cycle don't really bode well. It normally precedes a recession and markets collapse shortly after that. A September rate cut has been confirmed, but will it be a 25 basis points cut or 50 points drop? The size of it really matters in this case. Cutting one shows that everything is according to plan, but a double cut at 50 basis points would mean rescuing an economy that's crumbling. That would be the narrative, and we could get another market shock like the yen carry trade. So a lot will be hinging on the August payroll report. If jobs collapse further, bad news will really be bad news this time. The market expectations for the Fed cuts are changing very fast, and if anything shocks the market to bring forward the cuts, this house of cards could collapse fast. In September, 76% believe there will be only one small cut coming. A quarter are betting on a 50-point cut, and these are the baseline expectations. But in November, the market is expecting faster cuts that could plunge rates down to the lower bounds of 4%. Nearly half are betting that rates will drop to 4.5% or below, which means 2 or 3 additional cuts after the coming September meeting. And by the end of the year, there's a chance we could drop even below 4% in a worst case scenario. Remember that the Fed has a very narrow glide path. They have to maintain the facade of a strong economy. Even though it's weakening, Powell can't afford to cut rates fast. It's just sending the wrong message to the market. Digging into his statement at Jackson Hole, Powell made a pretty big admission. Cooling in the labor market is unmistakable with job gains slow this year. It's unlikely the labor market will be a source of elevated inflation pressures. In other words, the labor market is crumbling, unemployment is up, and people are losing their jobs. And if we stay higher for longer, this will most certainly guarantee a US recession. So all eyes should be on the US labor market. The Fed has broken their dual mandate of stable prices and low unemployment. Prices, we all know they are far from stable, but Powell has surrendered to inflation to save the collapsing job market. Even the Biden White House is trying to hide the big crash in jobs. A top US official, Gina Raimondo, the Commerce Secretary herself, is denying reality.
When you hear that, do you potentially think that this new numbers could be a liability for this campaign?
No, when I hear that, first of all, I don't believe it because I've never heard Donald Trump say anything truthful.
It is, though, from the Bureau of Labor.
I'm not familiar with that.
The US payroll recently had a monster revision to the numbers, and this has changed everything. In the past, people really didn't care about it, they only paid attention to the first print. But just look at the absolute disaster this year, a negative revision of 818,000 jobs, making it the worst drop in history since 2009. And this is during an election year as well, so how much more are they hiding from us? If we get another jobs disaster in August, that could force the Federal Reserve to hike faster. If Gina Raimondo had to deny the big revision, something tells me the underlying economy is crumbling. And let's focus on one key part in the recent Fed minutes. For over 2 months, the Federal Reserve already knew the labor market was in trouble. They already wanted to cut rates early. Many participants already suspected that reported payroll gains might be overstated. In other words, they didn't trust the job numbers from the government itself. They also found data pointing to a lower hiring rate and a downtrend in job vacancies. This isn't a sign of a strong economy, it signals a weak economy. Companies stop hiring because they are losing business. Sales are dropping, so they are not trying to increase expenses. Downside risk to employment was seen as having increased, and continued easing could transition to a more serious collapse. And let's translate this Fed speak. The labor market is in trouble. We are afraid of payrolls dropping even further. We believe unemployment is heading up, and that could be the trigger to spark a recession. So the coming rate cuts in September, November, and December, they are all planned. It's not because the inflation fight has been won, it is to prevent this Jenga economy from just falling down. What happens when the Fed starts to cut rates? Will it save the economy or do the complete opposite? Mainstream media is telling us that a recession is still coming, and just a few rate cuts won't prevent it. The damage has been done, and there's no stopping the coming train wreck. And if we look back in history, things could get rather brutal, especially for the markets. Now, this is not written in stone, but we must look at what happens after the Fed starts to pivot and cut rates down. This is a very important chart. It shows us how the markets, especially the S&P, react when the Fed starts to pivot. Since the 1970s, when the Fed cuts rates after a hiking cycle, bad things tend to happen. The previous three recessions happened directly after the Fed did a pivot. In 2020, the market fell by 35%. The same thing happened in '08 and 2000 when the market crashed by over 50% in both cases. This can be very bizarre if we take things at face value. You would think that if the Fed eases, this should save the economy and the markets have to rally. By lowering rates to stimulate the economy, shouldn't this make money cheaper to borrow? Shouldn't trillions of dollars start bidding asset prices up? But in the short term, the cut itself could really send a shock to the system. Most people I know, they don't want a depression, they don't want a recession. Everyone wants a soft landing. But we must prepare for the worst. Now might not be a good time to spend money recklessly or go job hopping around. You could get rug pulled. The moment to panic, it seems, is when the inverted yield curve starts to uninvert, which we are at the brink of. Basically, long-term interest rates will become higher than the short-term rate. And this uninversion is right at our doorstep. The 10-year and the 2-year Treasury spread is the benchmark indicator everyone uses. We are now just 9 basis points away from the yield curve crossing the point of no return. Yields on a 10-year bond are about to go higher than the yield on the shorter 2-year bond. And it's bound to happen because the Fed is going to cut short-term rates at least twice this year, maybe even 3 times. The last time the yield curve uninverted itself, 6 months later, the great financial crisis started. This chart isn't here to scare you or to shock you, but to highlight the risks that are present, that we aren't out of the woods just yet. But if a crash does happen, then things get much clearer because inflation is still the name of the game. The Fed is cutting rates even though we are at 3% CPI, and the US government isn't going to stop spending either. Janet Yellen, for example, wants to transition towards a green economy, and that is going to require endless amounts of money, trillions of dollars every single year.
Being so close to the magnificent Amazon is also a reminder that the transition to a lower carbon global economy is also the single greatest opportunity of the 21st century. The transition will require no less than $3 trillion in new capital from many sources each year between now and 2050.
$3 trillion a year at the minimum, you heard it, and this is money that has been borrowed into existence. Yellen once again will issue more bonds and increase government deficit spending. There's a reason why even today I'm still in the markets, I'm still buying gold, stocks, despite the risk of a recession. Because the final destination is still an inflationary nightmare. And whoever becomes US president, whether it's Trump, whether it's Harris, will unleash their own version of inflation, and neither scenario will be good. According to the Peterson Institute, Trump's global trade war will cost US households over $2,600 a year. Slapping tariffs on China and the world will cause prices in the US to soar. Trillions more will have to be spent to reshore industries back as well. Bringing manufacturing jobs back to the US won't be cheap. The impact of this will be inflationary. The national debt and deficits will stay high. The Harris plan is just as bad. In fact, it might be even worse. She wants to throw a ton of money to the American voter. 25 grand for first-time home buyers and child tax credits amongst others. This is a form of direct stimulus. All this will cost at least $1.7 trillion, and that's money coming from debt and deficits. It directly increases the money supply in the US and the world. And we are not even talking about her price control scheme yet. So can we guarantee a recession is going to happen? Well, we can't. It's extremely hard to predict one, but history tells us that it should happen. Look at the bigger picture here. For over 2 years, government spending has not stopped. Despite higher borrowing costs, there's no reason why things will stop now. As much as we can give the bear case for market collapse, we could actually keep seeing asset prices fly higher. There's just too much money in the system today. A lot of capital is still on the sidelines waiting. Just in money market funds alone, there's around $6.24 trillion lying dormant. This is a crazy amount of dry powder that will eventually leave and flood into assets. This is money sitting in short term bonds, so when the Fed cuts rates, there's a direct impact on the yield. Sooner or later, people will sell out of them to chase higher yields. The only question we have is if this cash will enter the markets once the rate cut happens, or if the economy collapses first and then the money moves in. But either way, prices will hit higher down the road. There's a lot of pressure building behind the dam, and once that explodes, we'll see a ton of money flow out. So we could have a total bifurcation of the market and the economy, where people's standard of living gets crushed, but asset prices could keep flying up higher and higher. Now, this is not fair, but this is how the world works today. But let me know what you think. Will the Fed cut trigger a recession? Or will we really reach the promised land and get a soft landing? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.